I've seen a lot of comments lately about the characters in these videos, and yes, you're right. Some of the visuals are generated with AI, and it still makes small mistakes. But behind XRP Daily Brief, there's a real team. A team that tracks crypto news and on chain data literally every hour, with a special focus on XRP. Our only goal is simple: cut through the noise and bring you fast, clear, and useful information. This channel is for people who want XRP news, real research, real context. And as always, this is not financial advice. Make your own decisions or talk to a qualified professional. Now, let's get into today's story, because the CEO of BNY Mellon just revealed something big about XRP, and the implications could be far more serious than most people realize. BNY Mellon quietly safeguards around $57.8 trillion in assets for governments, funds, and giant institutions. One comment from their CEO can move more silent capital than a million retail traders refreshing their phones. When a bank that old, that systemically important, starts talking publicly about digital assets and tokenization, the ground under traditional finance begins to shift. Big players move in silence. Retail usually finds out last. In this video, we're going to break down exactly what BNY Mellon's CEO just revealed about XRP and digital assets, what it really means for global settlement and institutional liquidity, and why this moment might be a turning point that most people will completely overlook. By the end of this video, you'll know what they said, what they didn't say, and what it could mean for XRP's future over the next decade. Information is early advantage. Use it. So here's a question for you. If a trillion-dollar custody giant like BNY Mellon quietly positions itself around assets like XRP and tokenized real-world value, do you think retail is early or already late? Drop early or late in the comments, and tell me whether you think the big banks will adapt faster than the crypto-native players, or if they're still years behind. Your perspective might age very well, or very badly. What actually happens when a bank like BNY Mellon takes XRP seriously? We're not talking about a random exchange listing or some speculative influencer thread. We're talking about a 240-year-old institution that moves value for governments, mega banks, and trillion-dollar funds, suddenly speaking openly about digital assets and real-time settlement. When that kind of player even hints at using faster rails, the old system starts to look slow. Very slow. Don't just watch prices. Watch who is quietly upgrading the plumbing. Most people still see XRP as just another crypto token, but that's not how institutions think. For a bank like BNY Mellon, XRP isn't about memes or quick flips. It's about infrastructure, speed, and reliability. The CEO's comments fit into a much bigger pattern. Legacy finance wants the benefits of blockchain without giving up control of the system. That's the silent negotiation happening right now. If you want to understand the future, follow the rails, not the headlines. BNY isn't just a big name. It is one of the ultimate back-end players. Around $57.8 trillion in assets are under their custody and administration. That's pension funds, sovereign wealth, asset managers, and more. Now imagine that kind of mass starting to pivot into digital assets, real-time settlement, and tokenization. That's not just a narrative. That's an operating system upgrade for money itself. When the back end of the system upgrades, the front end eventually has no choice. Here's where it gets even more interesting. BNY Mellon's leadership has started to label tokenization as a mega trend, not a niche experiment, not a side bet, a mega trend. And they've projected that stablecoins and tokenized real-world assets could reach the trillions by 2030. To them, that's not sci-fi. That's a rational, conservative base case for how fast this market is evolving. When conservative banks start using the word trillions, you should listen more closely. And it's not just BNY Mellon saying it. Look at the roster lining up. Citi, JP Morgan, Bank of America, and BNY, some of the oldest names in traditional finance, are all building their own on-chain or blockchain-adjacent systems. For years, people asked, will the big banks ever touch this stuff? That question is done. Now, the only real questions are how fast, on which networks, and who gets left out. The game is no longer about if, it's about position. One of the most important ideas in this entire story is simple: tokenization. Instead of thinking about crypto as random coins, think about it as wrapping real world value, cash, bonds, treasuries, funds, into digital tokens that can move 24/7 at the speed of an email. That's the vision BNY's CEO is leaning into. Not just stablecoins, but tokenized securities, tokenized money market funds, tokenized treasuries, all managed and settled on modern rails. The value isn't only in the token, it's in the rails that carry it. Now, this is where things get very interesting for XRP. Because Ripple has been quietly positioning XRP and the XRP Ledger as a serious infrastructure layer for exactly this kind of tokenized world. We're talking about liquidity, cross border settlement, and enterprise grade stablecoins that can tap into institutional custody and compliance. When BNY Mellon talks about stablecoin reserves, on chain funds, and tokenized cash, XRP is not some random outsider. It's already in the room. The key question is, who becomes the default bridge in this new system? In the last year, we've seen BNY Mellon move from theory to actual products. They've launched specialized funds designed to support stablecoin issuers with a focus on 24/7 liquidity, regulatory alignment, and secure reserves. At the same time, Ripple has selected BNY as a primary reserves custodian for its own enterprise-grade stablecoin, RLUSD, tying one of the world's most established custodians directly into XRP-centric infrastructure. When the world's oldest bank is holding reserves for modern rails, that's a signal. Think about the strategy here. Ripple could have spent years trying to sign one giant bank at a time, chasing JP Morgan, Citi, Bank of America individually. Instead, they focus on key infrastructure players and platforms that already connect to thousands of institutions. You don't knock on 10,000 doors. You walk through the one door that controls 10,000 rooms. That's not hype, that's leverage. One of the clearest examples is the acquisition and integration of platforms that already sit at the center of institutional treasury flows, systems that connect to thousands of banks, manage money market fund allocations, and route large-scale liquidity. When those rails start integrating with digital assets, tokenized funds, and faster settlement options, XRP isn't just a coin on the side, it becomes a path. The best strategies don't chase attention, they quietly capture infrastructure. At the same time, BNY Mellon has been stepping deeper into tokenized funds. We've seen them involved in tokenized credit products, on-chain money market solutions, and collaborations with major tokenization platforms that are already working with Ripple and the XRP Ledger. Add to that the projects bringing tokenized US treasuries directly onto XRPL, treasuries that also link back to BNY's custody and servicing, and a pattern starts to emerge. The pattern is simple: tokenized value plus institutional rails, meeting on-chain. Now, let's zoom out and talk about the scale of this. Right now, the total value of tokenized assets on public networks is still tiny compared to global markets. We're talking billions, not yet trillions. On the XRP ledger, the amount of tokenized real-world value is still in the hundreds of millions. It's small, but that's exactly the point. This is the early stage, the proof of concept phase, not the end game. Tiny numbers today can sit on top of massive future pipelines. Because if BNY Mellon is right, and tokenization plus stablecoins plus on-chain cash instruments are heading toward multi-trillion-dollar scale by 2030, then today's charts are misleading. The real story is not the current TVL, it's which networks, which stablecoins, and which liquidity hubs are positioning to host those flows when the big money arrives. Position matters more than snapshots. Now, I want you to think about something that most people ignore: safety. For years, the crypto space has been hit by one brutal hack after another. Billions stolen from exchanges, bridges, and platforms that look too big to fail. Massive exchanges, even top 5 by volume, have been exploited or collapsed. And every time, retail pays the price. That's one of the reasons institutions are so obsessed with proper custody and closed-loop systems. Speed without safety is just a faster way to lose money. This is also why the custody side of the story is such a big deal. While retail is still arguing about which exchange has the best app, institutions are asking a very different question. Who can hold billions in digital assets with bank-grade security, compliance, and insurance? That's where players like BNY Mellon step in, combining traditional custody expertise with on-chain settlement, tokenization, and real-time reporting. The quiet money doesn't chase yield, it chases security and control. So when the CEO of BNY Mellon goes on record saying that digital assets and tokenization are mega trends they are actively investing into, he's not talking to speculators. He's talking to pension funds, insurers, asset managers, and treasurers. The people who move size, the people who do not care about meme coins, but care a lot about settlement risk and counterparty exposure. When that crowd moves, they rarely move back. Now let's connect this directly back to XRP again. Ripple's entire thesis has always been that cross-border payments, liquidity management, and institutional settlement are broken on legacy rails. Fees are high, settlement is slow, friction is everywhere. XRP and the XRP Ledger were designed to be a neutral, fast, and liquid bridge asset that can plug into many different systems. Not just one bank, but entire networks of banks and platforms. The more tokenized assets appear, the more bridges the system will need. And that's why all of these seemingly separate headlines, BNY Mellon calling tokenization a mega trend, launching on-chain funds, custoding stablecoin reserves, linking up with platforms that are integrated with XRP, they're not random. They're puzzle pieces. They point toward a world where traditional finance and crypto don't compete. They merge. The rails are changing. The value is following. Mid-video, let me ask you this. If you're getting value from this breakdown, if you appreciate daily research and clear explanations on what's really happening behind the scenes with XRP and institutional money, take a second to subscribe to XRP Daily Brief and turn on notifications. That way, you don't rely on the algorithm to surface the most important shifts. You get them straight every day. Staying informed is free. Missing the signals is expensive. All right, second half. Let's go even deeper. One of the most underrated shifts right now is the move from speculative narratives to real revenue-generating products. When a bank like BNY develops tokenized funds, stablecoin reserve products, or on-chain liquidity solutions, they're not doing it for fun. They're doing it because there is demand from clients who want faster settlement, better transparency, and operational efficiency. Real demand doesn't care about crypto Twitter. It cares about results. You can already see how the pieces line up. On one side, you have banks and custodians modernizing their back-end systems, connecting to 24/7 rails, and preparing for tokenized cash, bonds, and funds. On the other side, you have networks like XRP Ledger, purpose-built for fast, low-cost settlement and enterprise-grade use cases. And in the middle, you have companies like Ripple building the bridges, acquiring key platforms, and integrating with large institutional partners. The middle layer is where the real power sits. And here's the part most retail investors still underestimate. As tokenization grows, most users won't even know which blockchain they're using. They won't care. Just like people don't think about internet protocols when they send an email, institutions won't obsess over whether a transaction finalized on XRPL, another chain, or a hybrid system. What they will care about is cost, speed, compliance, and reliability. The winning rails will be invisible, but unavoidable. Right now, if you look at the on-chain data, the total tokenized value on the XRP Ledger might not look impressive compared to the global capital markets. A few hundred million here, specific projects there, some real-world asset platforms starting to tap in, but that's exactly what early infrastructure looks like. Underwhelming at first, overwhelming later. Early systems always look small until something big plugs in, and that's why the identity of the partners matters so much. When you see names like BNY Mellon, major asset managers, and serious tokenization platforms building around the same rails Ripple is touching, you're not looking at a meme narrative. You're looking at plumbing. You're looking at the scaffolding of a new financial layer gradually being bolted onto the old one. The narrative changes, then the system follows. Zoom forward a few years. Imagine a world where tokenized treasuries, tokenized funds, and tokenized cash move nonstop, 24/7, 365, across networks that settle in seconds and cost fractions of a penny per transfer. Where sending large value internationally feels as trivial as sending an email. Where XRP is one of the default liquidity bridges under the hood, not visible to most, but essential to many. That is the internet of value people keep talking about. The biggest secret in all of this is that most of the real build-out won't be loudly announced on social media. It will happen in integrations, in custody agreements, in back office upgrades, and in quiet strategic acquisitions. exactly the kind of moves we're already seeing around XRP, Ripple, and partners like BNY Mellon. By the time the crowd notices, the rails are already in place. So, what do you do with all this information? First, zoom out. Don't reduce XRP to a short term price chart. Think of it as part of a much bigger transition in how value moves, especially if it continues to sit at the intersection of banks, tokenization platforms, and on chain liquidity. Second, pay attention to which institutions are not just talking, but actually launching products, funds, and infrastructure tied to this new system. Talk is free, infrastructure is expensive. Follow the money. And third, stay critical but open minded. Not every partnership headline means something. Not every integration changes the game. But when the oldest and largest custody banks on the planet publicly state that digital assets and tokenization are mega trends they are building around, it's worth more than 1,000 influencer thumbnails. Sometimes the most bullish signal is a boring quote from a serious person. To wrap this up, the CEO of BNY Mellon didn't just say that tokenization is interesting. He called it a mega trend and backed it with real investments, real products, and real client-facing solutions. Ripple, XRP, and the XRP Ledger are already touching the same terrain. Stablecoins, tokenized assets, institutional liquidity, and cross-border settlement. The story isn't finished, but the direction is getting harder to ignore. If you found this breakdown useful, make sure you're subscribed to XRP Daily Brief so you don't miss the next institutional signal hiding behind a boring headline. Because by the time it turns into a viral narrative, the early advantage is already gone. This content is for information and education only. It is not professional advice. Always do your own research and consult a qualified expert before making financial decisions.